Bitcoin has been a little bit of a laggard and a little bit sensitive to this tighter liquidity. It's got a more sensitive liquidity-driven price to it. But my sense is that, if you look historically, another chart, I'm not going to show it, but I've shown it plenty of times on my Twitter feed.
By the way, Bitcoiners, this is their Achilles heel. You guys study Bitcoin, but you do not study the legacy markets. They have weaknesses, and the Achilles heel for fiat companies, public companies, is the quarterly earnings. Stop spending money with the enemy.
Bitcoin, being more sensitive to liquidity, typically follows. We are seeing the early stages of that follow-through now. While Leopard admits he was early on his $140,000 Bitcoin prediction for this year, he maintains that the power law is in full effect. We are currently below the power law line, which historically represents the best time to buy. When the floodgates truly open, the move from $90,000 to $200,000 could happen faster than anyone expects. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Maybe we should shift over into a little bit of what's going on in the market right now, what's going on with the Fed and stuff, which I'm happy to kind of take the lead on, because I think there's a lot happening that maybe is subtle, or maybe not. But I think a lot of the community is probably pretty depressed with what's going on in the price, and I'm just completely sanguine, not worried. I'd almost like to see it go down so I could buy some more, but as you guys know, I wrote this book, The Big Print, and I do believe print is coming. In fact, they've already started it gradually. Powell himself all said that they have to grow the balance sheet in order to support the bank reserves because they were getting too skinny. They were looking at a situation like the repo blowout of 2019, which was the precursor to the last big print. And they're saying growing their balance sheet, i.e. buying bonds, is not QE, but of course it really is, and they're just lying about that. They're just trying to rebrand it. And then this week you saw Caruso and then somebody over at the Bank of America come out saying that they think there might be some discussion this week. And this is perhaps why we're saying that we're recording this on the Tuesday before Fed Day. Fed Day is tomorrow, Wednesday. And both of these guys came out, and it would be reasonable to think they might have gotten some leaked information suggesting that the Fed was going to kind of aim towards something like a $40 billion a month purchase of Treasury securities to keep these reserves. And they're going to call it reserve management, not QE. And I think that thought leaking into the market might be why we see silver going through 60 and Bitcoin catching a bid off of 90. It's now 93, almost 94 this morning. And so I've often maintained that it's just a matter of time until they have to start printing again. It's really just kind of a mathematical certainty. And I've got a chart that I'd like to share that I think shows that. But what this is, I use this in a presentation that we just made to our investors. It's a chart done by a guy named Dan Oliver at Mermicant Capital, who's a gold investor, a good friend of mine. So what this is the exponential growth curve is just kind of a compound interest growth curve. It shows what happens when you compound something at 7% over time. And the black line, that's the lighter gray line that kind of goes up, smoothly in an arc. And the black line is the Fed balance sheet, which is a good proxy for the money supply or the reserves that they put into the system that the banks then lend against and create M2. And what you can see here that I think is fascinating is that every time the Fed balance sheet or the money in the system, because we've got debt growing more rapidly than we have underlying money supply, or GDP, you get to these points at which there's not enough money in the system to service the interest rate and the debt. And so you can see what happened. The black line slipped below the growth curve in 2008, and bingo, you had the panic of 2008 and the GFC. And of course, they fixed that very quickly, and they had what I call the first big print. And they took the Fed balance sheet from 800 billion to 3+ trillion. But then, of course, they realized that was a problem, and there was some inflation and other issues. And so they came in and they started to tighten it again, and Yellen started the process, and then Powell added to it. And that took you into 2019, when in the fall of 2019, the repo market blew out and went to 10%, and they realized bank reserves were too low. And he did a pivot, and he turned around and started printing money again. And then 3 months later, COVID hit, and they really hit the money printer accelerator. And up we went from, a balance sheet, Fed balance sheet of 3 trillion to, I think at its peak, it was close to 9, maybe a little over 9 trillion. And of course, that led to the 9% inflation that, wasn't transitory because Powell lied about that, and brought us back down to now 6.5 trillion. Look at what's the most interesting thing about this chart to me is look at where the two lines are right now. We're back to the point at which the liabilities are below the parabolic growth curve. And the last two times that occurred, it led to a quote unquote big print. And so to me, that's why I say this big print is imminent. I mean, it's going to happen. It's got to happen. And I think, Luke Roman says 6 months. Lynn All is a little more thoughtful about it. She says, well, we could just have a gradual print. And she may be right. But I tend to think that more likely what will happen is once the floodgates open, they're going to really open. You kind of see the indicators of all that going on because you've got Kevin Hassett is going to be probably appointed as Fed chairman, and he's talked about much lower rates. You've got Powell attacking Fed governors. I mean, they threw out Bostic for insider trading. They threw out Kruger for the same thing. They're going after the woman who lied about her mortgages. And he's basically trying to get control of the Fed board. And you've got Besant, Treasury Secretary Besant out there trolling, the whole Fed board saying, what's the Federal Reserve? It's universal basic income for PhD economists. I thought that comment was hilarious. and because he said they always get it wrong. If the Federal Reserve was the FAA, nobody would fly in airplanes because these people don't know what the hell they're doing. And he's right. And so, basically it's clear to me that, with an election coming up next fall and, Powell's term expiring in May, Hassett's going to get in there and they're going to run this thing hot. And, the good news is the economy will probably hold together and the stock market might even go higher nominally. But the bad news is that's going to be massively inflationary. And gold has already smelled it, which is why gold took off, starting in September and went from 2,600 to 4,400. Silver is smelling it. I mean, it's doubled in the last year, more than doubled actually. And Bitcoin, Bitcoin has been a little bit of a laggard and a little bit sensitive to this tighter liquidity. It's got a more sensitive liquidity-driven price to it. But my sense is that, if you look historically, another chart, I'm not going to show it, but I've shown it plenty of times on my Twitter feed. What we see is that gold, because it's more widely distributed, tends to move first, and then Bitcoin follows. And so, to me, gold has already sniffed out the monetary debasement, and it's moved heavily. And what's going on right now is Bitcoin's in the process of starting to follow. And so I fully expect, I've been wrong about, earlier this year, my prediction was end of the year, silver would be at 50 or over. I'm right about that. I said gold would be 4,000 over. I've been right about that. And I said Bitcoin would be 140. I've been wrong about that. But I think that 140, 150 is coming, sometime pretty early next year as these Fed changes take place. So just some kind of context on what I see going on in the market right now. And I know a lot of people are very, very impatient, but I started buying this stuff in 2013 or 14. I almost actually kind of forgot about it for a while. I was like, oh yeah. One day I opened up my wallet, at Coinbase. I was like, holy shit, there's actually some real money here. Because I paid $300 or $400 for it and it got up to a few thousand. So, and so I think, people just got to become more patient here. I mean, we are winning. We're going to continue to win. The power law is in full effect. We're below the power law right now. This is a good time to be buying. If I had a lump sum distribution, I'd do it right now. There will become a time when it's less good to be buying. I mean, we will go to 1.5 times standard deviation above the power law, and that might be 200, and it won't be quite as good a time to be buying. But I just think everybody needs to relax and realize that we are in the right place at the right time, and we're lucky to be here. So that was kind of long-winded, but I thought I'd give you my perspective on where we are now in the markets.
The beauty of Bitcoin is that it cannot be altered by these firms. Traditional finance, TradFi, is trying to bring Bitcoin into their world via paper Bitcoin and futures, but they are going to get their asses handed to them. For the first time in history, the institutions have to bend to our rules. Bitcoin's decentralization is its inefficiency, but that inefficiency is exactly why it works. It doesn't require trust in a PhD economist or an angelic leader. It relies on math.
There was the expedient and more profitable thing to do, and then there was the more honest thing to do. And and I was shocked at how early it appears. I think everybody in the fiat world probably is confronted with these decisions, and you have to start realizing, and I was in the private equity firm world with some guys who were, like typical private equity guys, right? I mean, they knew how to cut corners, and they were all about making as much money as possible, as fast as possible. And, even if it involved, some deception and so forth. And, I tried to walk a thin line there as long as I could until I couldn't take it anymore. And then I got out because I just realized that to be really successful in that world, you had to be willing to, more or less lie, cheat, and steal, particularly with respect to your investors. I mean, they were never giving their investors what they said they were giving them. They were just, shaving them in every single way possible. And so, I thought at the end of the day, I'll probably end up comfortable, not as rich as some of these other guys, but I want to, do it in a way that I know, I did it in an ethical manner. And, I don't know, and I think it just came from my father, who basically said, look, you gotta look at yourself in the mirror and feel like you did it in the right way. And he also said, that you just can't put a price. I think you probably did this, Gary. I know, Bob, you've done it since you left Gateway, and Gary Leland, I think you did it as well. I mean, you can't put a dollar value on working for yourself. I mean, the notion of not having a boss, of not having an asshole, that sets the ethical standards or tells you what to do, that's priceless, even if you make less money. So, I went out on my own at a certain point in time, and I never, looking back, I never regret it. I think, it's not unusual for young people, I think, to have to start out working for other people, because you don't really know the system, you don't really know the game, you got to learn, you got to get into the whole system, no matter what you're doing. But I think pretty quickly over time, you can sort out what's real, what's not, who's good, who's not, where you want to be, where you don't. And I think it leads many people, it leads them to say, all right, I'm out of here. This is not what I want to become. I don't care about that money, and I'm going to do it in a way that I think, that I think is sustainable and I feel comfortable with.
By the way, Bitcoiners, this is their Achilles heel. You guys study Bitcoin, but you do not study the legacy markets. They have weaknesses, and the Achilles heel for fiat companies, public companies, is the quarterly earnings. Stop spending money with the enemy. You will see these companies retract and retrace so fast. Budweiser, Cracker Barrel, soon to be Audi, BMW, Mercedes. These guys are going to get crushed because of quarterly earnings. And they're going to have to lie now. So if you stop spending money with Netflix, their quarterly earnings will go down. They will not be able to merge with other companies. They'll just say no to these people and buy Bitcoin with them. And buy Bitcoin, man. Don't spend money with Netflix, buy Bitcoin. $15 at Bitcoin is worth a lot more a month than Netflix. Bob, I learned something some time ago, and that was these industries they are different, but they're only different in nomenclature. And at the very common thread of them is 5 freaking consulting firms with a single playbook that they roll from industry to industry to industry. And it's literally in 8-year cycles, 8 to 12-year cycles. And you see the steel industry go through, then the oil industry goes through it. Funny enough, the oil industry is still the best commodity market in the world, the least fucked with and controlled. It's hilarious how it's all turning out. That deregulation policy in the 90s and 80s is really taking bite across the world.
Even though they adopt it, use it, invest in it, believe in it, support it, they can't really alter it. And that's the key, right? I mean, the rules are the rules, and we're going to make TradFi bend to our rules, not the other way around. And to the degree they think they can alter it, and they decide to, create paper Bitcoin, which they've been doing some more of that recently. If you look at the futures volumes, they're going to get their asses handed to them when, we ramp like we're doing this morning. So, it has to be adopted at the institutional and the TradFi level. But the good news is that they have to adopt it on our terms, not vice versa. We don't have to adopt their terms.
This is, a big issue for the wallet to wallet business. Hey, when I want to move $10 million of Bitcoin or $1,000 of Bitcoin, what's my exit fee?
Well, yeah, and that's the one that's really critical.
It's the key. And the only way I have been able to get around it, because I'm a commodities, like my whole business, everything I've ever done was built on supply and demand. I get comfortable that the market in 20 years will be the free market. Like if it's not intervened with though, if you intervene with it, I'm worried, oh shit, I could pay $1 million to get $1 million of Bitcoin off into the system.
Exactly. And the mentalities have to change. And Bitcoin's decentralization, which you mentioned earlier, is a little bit of a hampering point. Just like it was in the marketing, it's also in the technical development.
It's the least efficient method of doing anything, man. It is the least efficient. If we all trusted Lawrence was the angel of all angels and perfect, we would centralize it through Lawrence.
Right. But nobody can be trusted that way, and that's why it works.
Exactly.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.